Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mark-eitel.
All right, my name is Mark-eitel, and you're listening to the Mr. Mortgage Show. And you're in the right place if you want the data, the news, the tips, the tricks, the strategies, the inside information that you need to go out there and make better real estate and mortgage decisions for you and your family. We do this every week right here, same time, same station, and we are very happy to be with you. We've got a great show lined up for you this week. We're going to talk about things like interest rates. We're going to talk about the housing inventory. We're going to talk about appreciation slowing, all of the questions that are swirling around in your mind, because I know there's a lot of crazy headlines out there, and we get asked questions every day. So we're going to do our very best to answer all your questions. Hey, and speaking of questions, if you're listening to us on WPSL, welcome. We're super excited to have you as part of the Mr. Mortgage family, and we are honored to be on WPSL. I'm a local guy, born and raised here in South Florida. I was actually born down in Palm Beach County and grew up in a family of home builders. So I've been, kicking around these parts for a long time and always in either home building or real estate for my entire adult career. More or less, I was in manufacturing for a little bit of time, but I digress. But I remember Port St. Lucie when it was nothing but a sea of vacant properties and paved roads once GDC bailed and left us all holding the bag. So my grandparents owned a custom home building company, and we came up way back then to do some development, and it's been amazing to see the evolution of the city over the last 20 years. But anyway, I share all that just to let you know that I'm part of the community. I live here, I work here. We're broadcasting from the secret studio at Mr. Mortgage headquarters down in Martin County, but we serve the entire area and are really blessed to be part of the community. So now that that's out of the way and you know who I am and what all this is about, we encourage your questions. We encourage your interaction. You can give us a call at the Anytime hotline, which is 772-266-0555. That's 772-266-0555. That rings right here to the Mr. Mortgage studio. And my lovely producer and assistant, Miss Jennifer, will get your questions on the air. Actually, I sound like, what was that game show with, not Wheel of Fortune. What's the one that you say again? Spin the big wheel? Price is Right. I'm thinking of the Price is Right. Sorry about that. I digress. But anyway, so to get your questions asked and answered on the air, go ahead and call the Anytime hotline at 772-266-0555. But as I mentioned, we dive into the data each week. We read the headlines. We go through the news and answer your questions regarding real estate and finance. And one of the headlines I see pretty consistently bouncing around out there is home price growth slowing and inventory rising. And on the surface, that starts to feel a little bit like 2008. And if you were around back then, it was an ugly, ugly time to be buying and selling real estate. Well, maybe not buying real estate if you bought at the end of the crash, but certainly owning and selling was a challenge at that moment. So we dove a little deeper into that article, and I'll post it on the Facebook page. Oh, I might as well mention that too. We have a pretty robust Facebook page. Go to Facebook and search The Mr. Mortgage Show, The Mr. Mortgage Show at Facebook. And there we post all the articles that we use and the data sets that you hear us talk about when we're on the air. So I will post this article there as well. But basically it's referring to home appreciation slowing. And on the surface, that sounds like bad news. But the article goes on to say that it's still in the double digits, which is mind-blowing to me that we're in late summer of 2022 and we're still seeing these appreciation rates. And you might say, wait a minute, Mark, but I'm reading and hearing that sellers are cutting their asking price and we're seeing more and more price reductions. And that is all very, very true. But even at the reduced prices, the properties are still double-digit appreciation over last year, which is just amazing and robust. So that's one more example where the article is slightly misleading and the data kind of indicates something else. So we're going to continue to watch this, but at the moment, we're still seeing healthy appreciation and moderating interest rates. So if you are a buyer and the payment works for your budget, so you can afford the payment, you're paying $2,500 a month for rent and you're considering buying a property and the payment's $2,500 a month, it's not a bad time, in my opinion, to go out there and buy, because with a little more inventory and with sellers realizing that they can no longer ask for your first child and a pint of blood, and they want you to name your next child after them, I think those days are behind us for the most part. And we're seeing sellers willing to negotiate again, whether it's a discounted sales price or, hey, if you can negotiate a discount in the sales price, maybe use some of that discount in the form of a seller's contribution to pay some closing costs or to buy your interest rate down. I think those opportunities exist again, where as recently as 2 or 3 months ago, that wasn't the case. So on the buy side, I think it's rather encouraging that we're seeing inventory tick up a little bit and sellers becoming a little more realistic, because let's face it, for the last, 18 months, it was the seller's call, cash only, 30,000 over asking price. That was dangerous and mind-blowing to me. I can't believe people were suggesting doing that, but that's a whole nother show. I mean, I think waiving inspections and appraisals and all that stuff is careless. I mean, if you're gonna do that much waiving, you should be on the back of a sports car in a parade, because I saw people waving like they were the king and queen. They were waving at everybody, but never a good idea to waive your opportunity to make sure you're getting a good deal. And sadly, that was the case for a lot of people recently. And we're not seeing that moving forward. We're seeing the more balanced market bring back that sensibility where a seller and a buyer are working together again for the transaction. And it's just refreshing. So the headline of the article says, home price growth slows, but appreciation remains double digits. So it's super contradictory right there. And when you read into the article and see that we're still in a double digit appreciation rate, I think you can kind of sigh, and a sigh of relief, and realize that, moving forward, real estate still makes sense, especially if you can afford it. Don't get hung up so much on the interest rate. Don't get me wrong, getting the lowest interest rate is awesome and should be a goal. But, 2 and 3% interest rates, guys, they're not coming back. That was a product of the COVID response and the Federal Reserve's, monetary policy, buying all the mortgage-backed securities, flooding the market with liquidity. And that pushed interest rates down, which made money artificially inexpensive. A 4, 5, 6% interest rate, 7% interest rate. I remember 10% interest rate. It was a rule of thumb. If you could borrow money for 10% or less, that was considered a fair interest rate. And I know those are days gone by, but the reality is a 5.5% interest rate is still super affordable money. And think about it. We're seeing 9% inflation. So 5% money is not even keeping up with inflation. So that's pretty cheap money in the grand scheme of things. So I just throw that out there. I'm not discounting the fact that 3% was better, but the reality is 5 or 5.5, even 6%. That shouldn't deter you from making a purchase if you can truly afford it. I would focus on budget and not necessarily rate, because this article right here indicates that we're still seeing appreciation. And I think we're seeing it locally. I mean, houses are still selling. They're still selling for more than they did last year. The good news is you have more bargaining power than you did, and you can get a seller contribution. You can get a discounted sales price. And I feel like a buyer has a voice again. So that part is exciting. It's exciting to see us move back into a more balanced market where there's even playing field on both sides of the coin. So anyway, I share all that just to encourage you to look past the data and don't give up on real estate as a good investment, because it is. And the reality is, guys, we're paying someone's mortgage. We're either paying our landlord's mortgage or we're paying our own mortgage. And it's always better to pay your own, because even if appreciation slows to single digits or flat, just owning the property and paying down your principal each month, you're going to gain equity. So I'm a big believer in the benefit of owning real estate and gaining equity over time. And yeah, 20, 30, 40% appreciation is super sexy, but it's not necessary for real estate to make sense. Strong, steady, single-digit appreciation over the long haul can create significant wealth. So that's all I have for you at the moment. You hear the music rolling up behind me. That means we're going to jump into a short break. We're going to be back in 2 minutes to take all your questions. Get your questions on the air by calling 772-266-0555. We can cover any topics that you find interesting. And hang in there with us for 2 short minutes and we'll be right back. Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Here's another 5-star review.
My wife and I own a small business. And the way our accountant file our taxes, we don't show much income on tax returns. Because of this, it looks as if we don't make the money. This was a problem for our bank when we applied for a mortgage. But not for Mark. He verifies our income by using our monthly bank statements. Mark and his Mr. Mortgage team made a big difference for me. Yes, I am happy to recommend Mr. Mortgage Mark.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 772-266-0555.
All right, we are back. Again, my name is Mark Eitel. You're listening to the Mr. Mortgage Show. And if you have questions, give us a call at 772-266-0555. That's 772-266-0555. And just before the break, we were talking about, real estate long-term, time heals all type of thing. And I just want to share with you that I talk to clients every day that are super frustrated, and I get it, and they're sitting on the sidelines thinking there's a big market crash coming and that interest rates are going to pull back and tomorrow is a better time than today. And hey, for somebody that might make sense, but the reality is there's a very good chance that real estate values are going to hold, or at least hold close to where they are, because there's just not a ton of supply coming to the market. And you can see this in any place in life, whether it's at the grocery store or the car lot or whatever the case is. We've all experienced this recently. Supply and demand is what controls pricing and value. Not the cost of money, not the government, not monetary policy. It's purely supply and demand. And right now, today, as we're on the air this beautiful Thursday, right here in sunny South Florida on WPSL, there is still more demand than supply. We don't have to look that far back to see the power of supply and demand at work. We all lived through the pandemic together. We all experienced the same shortage of products and services that were necessary to us. And I think about paper towels, toilet paper, and hand sanitizer. We couldn't find that anywhere. There was none at Winn-Dixie, none at Publix, none at CVS, none at Walgreens. And what did we do? We went online and we looked everywhere we could find it. and we bought it anywhere we could, and we paid whatever we had to pay to get it. And I know this from personal experience because I completely scavengered around and found what I needed in the most obscure places. And I bought products I had never heard of before simply because I needed them. Heck, I remember people were paying $20, $30, $40 for, a decent sized squirt bottle of hand sanitizer on Amazon or on eBay. And we all saw those news articles where people went out to all the dollar stores up and down the East Coast and bought everything they could and hoarded it in a warehouse somewhere in Tennessee, and then opened an eBay store, and they were selling all of this at crazy price gouging prices. And the reason I'm sharing that is supply and demand is what dictated that market. Suddenly, there was no supply and there was heightened demand because, let's face it, a lot of people were dirty. They weren't even washing their hands regularly, let alone using sanitizer. So everybody suddenly wanted to carry sanitizer with them, and there was not enough, and it just blew prices right through the roof. So I share that only to use it as a guide in looking at anything. We saw the same thing with used cars during the pandemic. All of a sudden, there was not enough inventory and people overpaid for vehicles. My God, I'm helping a gentleman right now. He bought 2 diesel trucks for his company during the height of all of that craziness, and he did 100% financing, sign and drive. But my God, his truck payments are over $1,000 each. I mean, I remember mortgage payments were $500 a month, and this guy's paying, over $2,000 for 2 vehicles. So we're doing a cash-out refinance, debt consolidation refinance for him, paying off a bunch of credit cards and paying off those truck payments because demand has cooled a little bit for used cars, and the values have come back down, and he owes more than they're worth. So he can't refinance them and he can't sell them. So he's stuck. And his credit cards, man, his interest rates are, I think one of them was 24.275. I don't remember, but both of them well into the 20s on the big credit cards. And then he had a bunch of little credit cards. But anyway, don't mean to be telling his story out of school, but we're using a debt consolidation loan to pay off all of his debt. And yes, his mortgage interest rate is going to go up a little bit, but he's going to save a ton of money each month by rolling it all into the one payment. And I get it. Dave Ramsey would hit me over the head with a baseball bat for even suggesting it. But the reality is this guy needs to reduce his monthly outflow so that he and his family can survive. I mean, gas is more, food is more. This guy's doing what he has to do, and he's blessed with a load of equity, and hopefully he learns from his past spending and doesn't do it again. But anyway, I didn't mean to go off on that bunny trail, but I just share that supply and demand controls the market. And right now, today, as we speak, there's just more demand than supply in the market. And we'll watch supply. I mean, that's a leading indicator of price reductions is oversupply. We just have not yet seen it. As I think about it, I've got a great image of the 4 cycles of any market, whether it's, used pickup trucks or housing or squirt bottles of sanitizer. It's the 4 cycles of any market, from normal to expansion to contraction to normal again. I'll go ahead and post that to the Facebook page too, because I find that super, super interesting. But all of that being said, I've promised you that we're going to get to your questions, and I'd like to start by throwing it over to my producer, Jennifer, and see if we have any questions queued up. Hey, Jennifer, what do we have?
Anna sent us this one. I talked with a lender who said I need to have a 690 credit score to get a mortgage. Is this true? I'm not a first-time buyer, if that matters.
Hey, Anna, thanks for that. That's a great question. That's not the case. So some lenders are tightening guidelines because of what's happening with monetary policy, and they've raised credit score requirements. The good news is there's a host of loan programs out there with credit scores as low as 620. Some programs even down to 580, but a real safe benchmark is 620. The higher the better, don't get me wrong, but you do not need a 690 credit score to get a mortgage. We are regularly getting people approved using an FHA loan and them having a low 600 credit score. So 690 is not required, but as I mentioned, always the higher the credit score, the better. And I know FHA and VA loans, and don't get me started on VA loans. I'm a huge fan of the VA loan. I'm a huge fan of the veteran community in general. Proud active member of the American Legion. but the VA and FHA buyer were kind of, cold shouldered out of the market of late because there's a misconception about that loan being a difficult loan to close and there being risk associated with it on the seller side, which truly infuriates me because it's not. It's just misinformation. And I'm happy to answer any FHA and VA questions that you may have, because I think that they're an amazing loan program. And if you're a seller, you should open up the opportunity to anybody who wants to buy your property, and especially a veteran. My God, they earn the right for that entitlement. It's actually called entitlement. They're entitled to use that loan product, and it's not a risky loan for the seller, and it does not indicate that they're a weak buyer because they're not putting a big lump sum. Why would they put a big lump sum down if they're qualified for 100% financing at 5%? I mean, they can leave that money in the stock market that they were going to use for the down payment and make far more than 5% in the long run. So anyway, I don't want to go too far down that path because the VA loan is a passion of mine. But to answer your question, no, you don't need a 690 credit score. There are a host of loan programs available all the way down into the low sixes. I mean, the VA loan doesn't even have a minimum credit score requirement, although some lenders do require a 550 or 580 minimum. Anyway, I hope that answers your question. Stay encouraged. A 690 credit score is a pretty darn good credit score, and with that score, you'd be entitled to a loan for sure. But if you're lower than that, there's opportunity there all the way down to the low sixes pretty regularly. But if you have any more questions about that, you can give us a shout at 772-266-0555. That's the Anytime hotline. And as I mentioned, that pushes to my office during the week if you need us. So hopefully that helps. But yeah, I encourage you to go out there, reach out to us or reach out to somebody, because I think there's an opportunity. I don't know how close to that 690 number you are, but if you're over 620, you've got a host of programs available to you. So that's where we stand there. So I hope that helps. You hear the music coming up behind me. That means we're going to run into a short break. We're going to be back in 2 very short minutes to answer more of your questions. Hang in there with us for more of the Mr. Mortgage Show right after this break. Hey, it's Mark Eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com. www.reallyGreatAgents.com.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 772-266-0555.
All right, my name is Mark Eitel, and you are listening to the Mr. Mortgage Show, and always my favorite part of the show. I know we've got some questions queued up over there because I see Miss Jennifer has given me the finger. Well, she's not giving me the finger, but she's holding up her finger, indicating that we have questions. So, hey, Jennifer, do we have questions?
We have a bunch of questions. Are you ready?
All right, great. What do we have?
Brent wants to know, what is the minimum documentation for an investment property mortgage? I'm self-employed. I show losses. I'm looking for a hassle-free loan. Any tip?
Okay, Brent, that's a good one. So you're looking to buy an investment property, but you don't want to have to do a full document loan. I get it. There's a lot of people who are self-employed who show losses on their tax returns. And whether you're trying to buy an investment property or a home for you and your family, that can be a challenge. Yep, I totally get it. So I'm going to answer that question two ways. First, let me start with the investment property. We have a loan product called the Landlord loan. So with the Landlord loan, you have to have decent credit, and you've got to be able to verify assets because you're going to have to put, 15 to 20% down on the property. But then that's it. We look at the rental income from the investment property. So if the property cash flows, meaning the rent supports the debt, and by debt I mean the principal, the interest, the taxes, and the insurance. And if there's any HOA fees on the property, we throw that into the calculation. So if the rent covers the debt, we call that cash flowing or penciling, some people will say. If the property pencils or cash flows, you're good to go. So if you've got decent credit and you can verify assets, you can use our Landlord loan and not have to get into income, not have to get into tax returns, any of that, which makes it ideal for people in your circumstance. If you were self-employed, showing losses on your tax returns and trying to buy a property for you and your family, there's another loan product called a bank statement loan. And what the bank statement loan is, it's a loan that allows the underwriter to use an average of your monthly deposits as income verification. So let's say you deposit $10,000 a month into your checking account, and we look over the last 12 months and see that you averaged $10,000 a month in deposits. Well, depending on your profession, there's a factor applied to that $10,000. And the reason that's specific to profession is it's logical that some professions are going to have more expenses against income than others. Let's say you're a consultant and you work from home and your work product is data or reports and you're delivering it via email. You don't have a ton of expenses against that. You've got whatever, your computer, your printer, whatever subscription services you need to do your data research. You're going to get a higher percentage of those deposits calculated as your income versus somebody who, let's say, is a contractor or a lawn maintenance company. You've got equipment maintenance and gas. With gas, those guys have to be really getting hit right now. Their cost of fuel is doubled. But anyway, you get my point. If you're in a profession that has a higher cost to income ratio, then that number is going to be smaller. That's how the income is calculated. So they'll take an average of your last 12 or 24 months bank statements to verify income. So those are the two loan products that are ideal for a self-employed individual who either doesn't claim all of their income on their tax returns or they show losses, but you may make the income. And it's not uncommon for self-employed people. Listen, we all go to our CPA or our accountant and we hand them a shoebox of receipts and say, hey, I want to pay as small a tax bill this year as possible. I've never seen someone go to their accountant or their CPA and say, hey, I want the largest qualifying income that I can use for a mortgage application, because you're going to pay more taxes. So I get it. It's counterintuitive to want to claim a high income number on your tax return because you're going to pay a larger tax amount. So because of that, the industry has designed these loan programs to work around that. So it's a viable option for somebody who wants to buy but can't show or perhaps doesn't show all their income on their tax return. So, hey, Brent, that was a great question. Thank you for it. I hope that helps. If you need more information or want to continue the conversation off the air, just give us a call on the Anytime hotline, which is 772-266-0555. But thank you for that. Let me throw it over to Jen and see what else we have.
Sandy sent this one. I've been renting forever. I want to buy a little place for me and my daughter. I just don't know if I should wait. Do you think rates or prices should come down?
Hey, Sandy, you're not alone. I mean, I kind of spoke to that in the opening segment of the show. I personally don't think that the market is going to crash. Now, I do think some areas are going to have a little bit of pricing pullback. And what I mean by that is we all know the areas. We drive through them. We may live in them. Listen, I grew up in an area down in West Palm Beach called Palm Springs, and I drive through my old neighborhood, and in my mind, I can't fathom the values of those homes. I think some of those older Florida homes, 2-bedroom, 1-bath, carport, I think some of those properties got swept along with the appreciation because people were buying what they could buy. Do I think that those neighborhoods are going to hold these all-time high values? I don't, but I don't think they're going to crash. I think they might pull back a little bit. And by a little bit, I don't have a crystal ball. 8%, 10%, I don't know what the answer is. And I don't know over what time period they're going to pull back. So I understand your hesitation. The one thing I want to just mention to you is look at your budget. Can you afford to buy the house? Can you afford the payment? Could you live there comfortably with you and your daughter? Could you live there comfortably for a long period of time with you and your daughter? I have many, many clients that purchased at the peak of the peak of the peak in the housing bubble of the early 2000s. There were 3 categories of individuals back then. I've got some past clients who just stopped paying and pushed their keys across the desk to the bank and went into foreclosure and gave the house back and then had to start over, rent, and rebuild their credit. There was another group of people who did strategic defaults. They stopped making their payment and then negotiated mortgage modifications. And for a lot of those people, it didn't really work out as well as they thought. They nicked up their credit. And at the end of the day, they cost themselves some equity with the additional fees and legal fees associated with it. And then I've got a group of people who just wrote it out. They had decent jobs. They liked where they lived. They didn't like the fact that the property values went down, but they just kept making their payment. And over time, everything corrected. And I can think of one individual right now, and I'll share their story at a later date. Their property was at one time worth less than half of what they paid because the neighbors in the neighborhood, some properties went into foreclosure and sold at auction at far less, but they stuck it out. They made their payments and they own that property now free and clear and have a little over $500,000 in equity. So I share all that just to encourage you to look past today and see if it works for you long term. Because if it does, and the payment is at the rent rate or lower, then logic would dictate that if at a future date you wanted to move and couldn't sell it, you could at least rent it out and cover the expenses. So I share that only to caution you not to sit out an opportunity because the headlines are frightening you. If you can qualify for a mortgage and you can make the payments comfortably, don't go out there and overextend yourself. And the alternative is rent for the same amount or, give or take a little bit either way, then I think buying a place for you and your daughter makes sense. And I'd love to have a conversation with you off the air and answer any questions that you have. And guys, I don't have a crystal ball. I don't. What I do have is a lot of gray hair, a pretty decent bald spot, and my 6-pack abs are long gone. But what I mean by that is I have some experience in the market. I've seen some things. I've seen some people do well and do poorly. If you buy real estate for the right reason with the right loan products and you can afford them, I don't think there's a long-term risk in doing it. So don't get scared by the headlines. Don't get scared by Federal Reserve raises interest rates 75 basis points because guess what, guys? That did nothing to mortgage rates. Mortgage rates took that on the chin. As a matter of fact, the day the Fed raised, mortgage rates fell about a 16th. So the mortgage rates are pretty stable and historically quite affordable. So, hey, Sandy, if you can make the move and you and your daughter are better off in the house, if it puts her in the right school zone, get you each your own bathroom, whatever the case may be. That reminds me of a past client I have. She allows me to share her story. Her name is Mary, but I'll share her story at one time or another. But go ahead and explore the opportunity. If you're qualified, I would encourage you to do it. But look at the budget. Make sure you can afford it. So anyway, you hear the music rolling up behind me. That means we're going to run into another break. On the other side of this break, we're going to continue with your questions. Thanks. Hey, it's Mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction, and that starts with a really great agent. If you've got a great agent, that's awesome, but if you don't, check out www.reallyGreatAgents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallyGreatAgents.com, www.reallyGreatAgents.com.
Here's another 5-star review.
We kept our business above water with credit cards during the pandemic. I'm glad we did. Business is better than ever. But I didn't want to be a slave to those credit card payments. I called Mark about the REC loan he advertises. Long story short, we did a REC refinance and paid off everything, even the car. Now we only have the mortgage payment. We're saving a bunch every month. Yes, we are happy to recommend Mark and the Mr. Mortgage team.
Hey, it's mark-eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 772-266-0555.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. Hey, if you like what you're hearing and you want more of it, check us out during the week. Go to mrmortgageradio.com, mrmortgageradio.com. There you'll find the entire library of previous radio shows. We've been doing this for a while down in West Palm, and recently happy to be part of the WPSL family. We're doing this one just for you. So if you want more of the show, check us out at Mr. Mortgage Radio, or go to the Facebook page. Go to Facebook and search The Mr. Mortgage Show. That's The Mr. Mortgage Show at Facebook. There's a ton of useful data there, great articles. We post all of the data sets that we use during the show there every day. And lastly, you can visit www.mrmortgage, no .com, just type in Mr.Mortgage, and that's our corporate site. So go ahead and try that out. A lot of people think it's super cool. You don't need to type in .com. Just go up to your browser, type in Mr., the little dot, then mortgage, and then boom, there we are. So anyway, that's how you find us during the week. The Anytime hotline is 772-266-0555. That's 772-266-0555. That one is just for the PSL listeners, but that pushes to my office during the week. So if you've got questions that you want answered during the week, you can use that number then. But it rings here in the studio during the show, and Jennifer is manning that phone line. So I know we've got some more questions teed up. We had some come in during the break, so I'm going to throw it over to Jen and see what we have teed up.
Joan and Thomas emailed us. How soon after we purchase a house can we qualify for a reverse mortgage?
Hey, Joan, thank you for that, Joan and Thomas. So I that's interesting, because if I'm hearing you right, if we're understanding your question correctly, you want to buy a house and then put a reverse mortgage on it as quickly as possible, which I totally get. You may not need to do that. So there's a strategy where you can use a reverse mortgage to purchase your property. A lot of people don't even know that exists. First of all, there are a lot of mortgage companies that are unfamiliar with reverse mortgages to begin with. And a lot of people have a misconception about reverse mortgages. Or I guess that's not true. It's not a misconception. It's a dated perception, because there were a lot of people hurt by reverse mortgages previously. They were misused by financial planners. We're using reverse mortgages to help seniors pull equity out, and then the financial planners were having them invest that equity and then losing that equity in risky investments. So there have been significant changes to how the reverse mortgage program works because of that, and all for the better. It's a much safer program now, and allows you access to your equity. So to answer your question, let's talk about a reverse to purchase rather than closing and then quickly putting a reverse mortgage in place, because then you're paying 2 sets of closing costs, 2 sets of everything. And I want to share an example of where a reverse mortgage for a purchase makes sense. And this example is around, and who I happen to know, this individual has raised their family and his wife passed away, and now it's just him. And he's in the big house, all paid off, no mortgage, but no kids, and they're in a neighborhood that the neighborhood's changing. He's there by himself. He wants to be in a community of more people like him. He wants to ride the little bus to Whole Foods and to the mall, to the movie theater. There's a lot of cool aspects to living in a retirement community. And there's some pretty cool 55 plus communities out there right now. So anyway, before I get sidetracked, back to the story. So he owns the house free and clear. It's worth, let's say for this example, $500,000. And he wants to move into the new 55 plus neighborhood for all those reasons that I just shared. But the units in that 55 plus neighborhood are 500,000. So he could sell the property, take the $500,000, go down the street to the cool neighborhood with the little bus shuttle to all the nice places and the pickleball courts and the, bridge games and all the cool parts about living in that community, and put his $500,000 into the property. And he's upgraded his property and he's in the neighborhood he wants, but he hasn't improved his cash flow position. Or in this instance, what he's thinking of doing is selling the house, taking that $500,000, going down to the street to that really cool community and putting $250,000 down on the property and putting a reverse mortgage in place and putting the other $250,000 in the bank. Now, the upside to that is he's got $250,000 in the bank for cushion money, because what I neglected to mention was he's outlived his savings. So he's living on a very tight budget, on a very fixed income, and he's got very little money left in the bank. So by doing a reverse to purchase, he could buy the property, put $250,000 in the bank, $250,000 in the property, and never have a monthly mortgage payment again. This might be something that applies for you, because as I'm understanding your question, you want to buy the property and then put a reverse in place, most likely for all the same reasons. You want to put some cash in the bank and you want to forego that monthly payment. In that instance, it might be worth considering a reverse mortgage to purchase. So I believe strongly in the reverse mortgage product, but it's not for everybody. It really isn't. So I say that only because there's many parts of a reverse mortgage that need to be considered before you jump into it. So I'd welcome the opportunity to have a discussion with you offline about that. And I'd encourage you to give us a call at 772-266-0555, and I'll be happy to answer any questions. That is a great, great product for the right person and can mean a world of difference. So thank you for that question. It's a great, great question. And a reverse mortgage for purchase is a strategy that a lot of people are unaware of. So I welcome the opportunity to go deeper with you on that. So thank you again for your question. Hey, Jen, what else do we have?
Sammy sent us a text. I think we're in for a serious recession, and I want to pull out some cash now. I'm leaning towards an equity line. Any advice on an equity line versus a cash-out refinance?
All right, Sammy. Hey, that's a great question. I think we're already in a recession. How serious it becomes, I'm not sure. I mean, we are seeing a lot of inflation pressure. The recent interest rate increases have cost everybody more money. Your credit card payments are going to go up. Any adjustable rate debt you have is going up. Listen, everything we buy is going up because most manufacturers and most big distributors run their businesses on adjustable lines of credit. So their cost of money just jumped up. So that's going to get passed down the line, sadly, to the consumer who's already getting their butt kicked by this recession. So great, great question. The advantages of an equity line are the simplicity. So I've got a contact at one of the local banks I'll be happy to refer you to. It's an amazing program. It's a low interest rate. There are very little closing costs, no upfront fees. It's interest only for 10 years. And then if you have a balance after 10 years, it converts to a 20-year loan. Now, those are all of the advantages. The disadvantages of an equity line are every time the prime rate goes up, so does your payment if you have a balance outstanding, and that equity line availability can be reduced at any time. And what I mean by that is if we do get into an environment where your property values go down, your equity line availability can be adjusted downward also because it's based on the value of your property. And also too, if your value goes up, you could request an increase. But during the housing crash in 2009, 10, 11, 12, we saw many people's equity lines being closed or greatly reduced because they were losing equity. So that's one of the downsides. The cash out refi strategy, the upside to it is you've stabilized that payment over a longer term. So if you're going to take, $50,000 out and pay off a bunch of debt, you've now taken that $50,000 and stretched it over 30 years at, by today's rate, maybe 5.5%. So you're going to have a lower monthly payment, but your payment's going to go on for longer. So long term, you're paying more interest for it, but you're never going to worry about interest rates changing. You're never going to worry about property values changing. And if the property values go down, you can owe more than your house is worth, and they're not going to come knocking on the door and force you to give any of that money back. So there are pros and cons to both sides of it. I'd love a conversation with you if you need further information, but I appreciate the question. I'd really need to understand what your strategy is around paying back the debt, the borrowed money. If it's a short term, you're going to use the equity line for an opportunity, or you're going to use the equity line for something that you think you're going to pay off quickly, then, by all means, that's the way to go. But if you're trying to stabilize your monthly outflow over a long period of time, the refi might be a strategy to consider, but I would need to know much more. So anyway, I hope that helps. We're going to jump into another break, and on the other side of this break, we're going to take more of your questions. Thanks. Hey, it's mark-eitel, host of the Mr. Mortgage Show. You hear me all the time talking about the need to have the very best team representing you in a real estate transaction. And that starts with a really great agent. If you've got a great agent, that's awesome. But if you don't, check out www.reallygreatagents.com. There you'll find the best of the best, regardless of the city they work in or the brokerage they work for. www.reallygreatagents.com, www.reallygreatagents.com.
Here's another 5-star review.
As a realtor, I have a bunch of mortgage brokers to choose from, but I prefer to work with Mark and his Mr. Mortgage team. In this crazy market, there is no room for error, especially on the mortgage side. Mark's team moves fast, keeps everybody in the loop, and makes things happen. They always give my clients a great deal and take the time to walk them through every step of the process. When you're considering a lender, I encourage you to talk to mark-eitel and the Mr. Mortgage team.
Hey, it's mark-eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org.
Are inflation and everyday expenses eating into your retirement income? Maybe you've considered a reverse mortgage and have unanswered questions like, do I still own my property? Can the bank kick me out? What happens when I die? Can I still leave my house to my kids? These are all great questions. Visit www.moreaboutreverse.com to learn more. That's www.moreaboutreverse.com. www.moreaboutreverse.com.
Welcome back to the Mr. Mortgage Show. Call us now, 772-266-0555.
All right, we are back. My name is mark-eitel, and you are listening to the Mr. Mortgage Show right here on WPSL. And we're just a few minutes away from the big boys. Clay and Buck are rolling up on us and going to take over the airwaves here in a minute. So, hey, we've enjoyed being their warm-up show, and you guys have been great. This has been a wonderful kickoff. I appreciate your participation. I appreciate all your questions, your texts. Jennifer's been smiling the whole time, so she's getting some great phone calls over there. But, hey, we're going to keep the party rolling. I'm going to throw it over to her for some more questions. Let's see what she's got teed up. Hey, Jennifer, what do we have?
Jerry left a voicemail. Can my dad be a co-signer on my mortgage if he lives in New York? I'm not sure if this makes sense. I live and work here, but he's in New York.
Hey, Jerry, that's a great question. And yes, so dad, it does make sense. And dad can be your co-borrower. And what's going to happen is he's going to be classed as a non-occupying co-borrower. So we're going to use, or whoever your lender is, I'd love it to be us, but if it's not, whoever you're working with, they're going to use both your incomes and both your debts. So just keep that in mind. If you're going to use a co-borrower, you're going to use all of the co-borrower. You're going to use their credit score, you're going to use their income, and you're going to use their debt. So assuming that the two of you together can support the debt to income ratio, sometimes you'll hear that referred to as DTI, as long as the debt to income ratio meets guidelines with both incomes and both debt loads, you're good to go. And one other caveat just to remember is we're going to use the lower of the two FICO scores. So whoever's lower, either you or your dad, that's the credit score that's going to be used for underwriting, but then both incomes and both debt loads. So yes, you can do that. It is not uncommon. We see it all the time. And awesome that dad's willing to do that for you. It's a great way to get started. We see parents gifting down payments to children often to help them get started because, building equity is an amazing opportunity to set yourself up for the future. And there are a lot of parents out there who see the value in that. A gift for down payment is quite often a strategy that's used. But in this case, dad's willingness to co-sign can help also. So he would be a non-occupying co-borrower. You can still apply for homestead exemption, and then you still get the benefits of the interest rate and the down payment associated with a primary residence purchase. So you'll be treated as a primary resident buyer. So you'll be treated as a buyer of a primary residence, even though you're using dad's income and credit as a non-occupying co-borrower. So great question. We see it all the time, and I hope that helps. If you'd like to talk more about it or you have additional questions, just use that anytime hotline, 772-266-0555. As I mentioned, that rings to my office when we're not on the air. But right now, today, it's ringing here in the studio, and Jennifer's manning that. She's manning that hotline, and she's been chuckling over there. So I think she's getting some pretty interesting phone calls. The WPSL crowd has not disappointed, that's for sure. So, hey, while we're talking about that, I just wanted to thank everybody for their participation. We are certainly excited to be part of the PSL family. As I mentioned earlier, I was born and raised actually down in Palm Beach County, but have been kicking around these parts for a long time. So we're excited to be here. You guys have been wonderfully welcoming. And hey, if you found any of this interesting or you think someone else can benefit from it, please share the show. We're always trying to build the listenership. And more importantly, we like to answer as many questions as we can. And I know we've got some stacked up. If we can't get to them on the air, I will personally either shoot you back a text or an email so we can at least get you that answer today. But do that for me if you would. Share the show. They can find us here every Thursday at 11 a.m. on WPSL. Or if you can't tune in live, go to MrMortgageRadio.com. That's MrMortgageRadio.com. There you're going to find the complete library of previous shows. We've been doing the radio show for a while down in West Palm Beach and have been waiting our turn to join the PSL crowd. So we're happy that they made room for us up here. They've been great. But we've been on the air for a while down there, so there's a library of episodes available. But that's at MrMortgageRadio.com, or you can check us out at Facebook. Just go to the Facebook page and search The Mr. Mortgage Show. That's The Mr. Mortgage Show at Facebook, or www.MrMortgageShow.com. www.mr.mortgage. That's www.mr.mortgage. There you'll find a ton of useful information. So that is all we've got for you this week. That was fast. You guys made it a very, very fun experience. So we will see you back here next week, same time, same station, warming you up for Clay and Buck. So say goodbye, Jennifer.
Bye, Jennifer.
All right, guys, have a great week. We'll see you next Thursday.
That's a wrap. Join mark-eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.
So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. One is to lower their rate, that's for sure. But there are many, many other reasons. Debt consolidation, unexpected medical bills, home renovation. I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's get back to debt consolidation for a minute. I'm working with a client now. His name is Ben. He's in Palm City. And Ben is going to refinance, pull some cash out, pay off 2 truck payments, as well as a host of credit cards. He's going to use a loan program called the REC-refi to reduce, eliminate, and consolidate his debt. So yes, his mortgage interest rate is going to go up a bit, but he's going to reduce his monthly expenses significantly. So if you'd like to learn more, tune in to the Mr. Mortgage Show every week right here on WPSL, Thursdays at 11 a.m. That's right, we're just before Clay and Buck. Or check us out online at Mr. Mortgage Radio. That's every Thursday at 11 a.m. right here on WPSL. Or you can find us online at Mr. Mortgage Radio. That's MrMortgageRadio.com.